Brett Newberry has been a CPA for 40 years and does traditional tax accounting along with forensic accounting. His passion is helping small business owners and managers improve their quality of life and income. He assists owners and managers with running their business instead of the business running them. He's a certified public accountant, certified fraud examiner, and fiscal management specialist.
I am Brett Newberry, CPA, certified fraud examiner. I've practiced for over 40 years in tax, accounting, CFO work, forensic work. I really enjoy dealing with fraud. I know that sounds weird, but fraud can be a very challenging thing to deal with, and I enjoy that work. It can have some very significant consequences of dealing with it, but I enjoy that work a whole lot. In fact, I'm very close to retirement, but I'm not going to retire fully. I'm going to move to northern Idaho. My wife and I are going to build our retirement home up in Sandpoint, Idaho, and I'm going to be semi-retired, and I'm going to work mostly in forensics in my semi-retired status. So anyway, before I get started on the program, this is really, really important stuff in regard to the sunsetting of the current tax code that we have, or tax act, that was passed in 17, I think it was. People refer to it as the Trump tax cut. That's not the official name, and so I'll refer to that, but it is a big issue. Before I get into it, I want to give you some statistics. What would a CPA be without statistics? I just want to briefly give you, it's not in the slides, but I just want to talk to you just briefly before we dive into this about our federal government in regard to the amount of money they take in, about the amount of money that they spend. I'm going to give you the last 5 fiscal years of the federal government. The feds run on a October to September fiscal year. So their fiscal year ends September 30th. So I'm just going to give you real quick here. All these numbers are in trillions of dollars. I didn't say billions, trillions of dollars, okay? In 2019, the federal government collected $4.14 trillion. They spent $5.12 trillion, deficit of about $1 trillion, only a trillion in 19. 2020, they collected $4.03 trillion, and they spent $7.16 trillion. That's sort of when COVID started to hit, and so expenditures you would think would be up, but they were up quite a bit. And so there was a deficit that year of $3.13 trillion. Next year, more COVID spending. Federal government took in $4.52 trillion. They spent $7.29 trillion. So there was a deficit of $2.77 trillion that particular year. 2022 took in $5.06 trillion, spent $6.44 trillion. So a deficit of $1.38 trillion. The last fiscal year that we have, because we're now in fiscal year 24, but it's not over yet. 2023 took in $4.44 trillion, spent $6.14 trillion, a deficit of $1.7 trillion. So over that 5-year period, the federal government has run a deficit of about $10 trillion. Okay? Now, if this was a client of mine, I would want to make sure I'm getting paid and then making sure the check cleared the bank before I did any additional work. So we definitely have a problem in this country. And so I just wanted to give you a little bit of flavor in regard to the monies that's being spent. It's astronomical, to be quite honest. I don't know if you've ever tried to write out $1 trillion with all the zeros. I mean, it'll blow you away. So anyway, if you see me changing my glasses back and forth, I just had cataract surgery, and I don't have my new prescription yet. I'm going to get it here. I'm going to go to Eye Associates after our meeting today, so I can order my new glasses. So if you see me switching back and forth, it's because I'm having to look up close and then looking a little bit of a distance. So let's get into the slides. And I want this to be interactive. The last thing I want to do is just stand up here and lecture to you about these things. So I'm going to throw these things out. If you have questions, ask me. Hopefully I can answer them. If not, maybe we can have a discussion and maybe somebody here might have an answer or at least a suggestion of trying to deal with a particular issue. The materials, it's a combination. Linda Parker put it together, and I do appreciate Linda doing that. And a lot of the materials comes from CLA. And if you're familiar with that, Barbara Lewis is one of their partners. Barbara is on our board, and I think she's going to be our treasurer. And Linda's a friend of mine, so I want to make sure I give her company credit. They have a really good newsletter that comes out, and I think that's where Linda took a lot of the material, was from their newsletter. I've tweaked it a little bit. I told Linda there was some stuff she had in the slides on trusts, and I just didn't feel comfortable being able to talk about that. So there is going to be some changes to trusts. I would suggest that you get with your attorney and your CPA and be able to talk about some of these issues related to trusts. But you need to be very proactive and make sure you pay attention to the presidential election on how it shakes out, because it could have a Congress too. So what we're going to talk about is stuff that's going to sunset. And what sunsetting means is that when the Trump tax cut was put into effect in 2017, they had sunset provisions in it. They did not make them permanent. There's some features that were permanent, but most of them were temporary. And that's what it talks about in regard to the sunsetting. Sunsetting means that these temporary tax code only is in place for a certain period of time. And the sunsetting will take place on December 31st of 2025, which is next year. And so it's very close for this thing to sunset. So you need to pay attention to the election. I'm not going to get into anything of the politics, but I'm just telling you these are big issues. And you need to be aware of them and be conscious of them, and you need to be very, very proactive. A lot of times I find clients don't want to deal with these issues. And I would tell you, because of the sunsetting provision in this tax act, you need to be proactive because you could be caught off guard. So, all right, let's go into it. Okay. I may need some technology help here, Keith. It's not, maybe just froze or, sorry about that. She told me to use these. Yeah, let me see. Oh, okay. There we go.
Is it going?
Yeah, maybe it was in sleep mode. Okay. All right, thanks, Keith. All right. This is the official name of the tax act that I refer to as the Trump tax cut. The official name is the Tax Cuts and Jobs Act. We've got several screens, so if I'm in your way, you can look at one of the other screens. And I'll just refer to it as the act, so I don't have to go through the verbiage each time, or even the acronym. It was massive changes to businesses and individuals, including the tax rates, which basically was very significant, which started in 2018. But I mentioned about the sunsetting. So that will be sunsetting at December 31st of 2025. So again, what'll happen if nothing's done, then what'll happen is the tax code will revert back to the way it was on sunsetting provisions, not permanent provisions. But on the sunsetting provisions, they will revert back to old law January 1st of 2026 if no changes are made. And this is just my opinion, I wish that these had been made permanent. I think these changes that were made, I think were significant for helping businesses, family businesses across the United States, and we'll talk about some of the reasons why. But they didn't, I'm sure it was the politics, that they couldn't get politicians on the same page of both parties to agree to make these tax changes permanent. And so That's why it has the sunset provision. That's why I wanted to lead off with the amount of money taken in and the money spent each year by the federal government. If the sunsetting does occur, what's going to happen is on January 1st going forward of 2026, the federal government can basically count on its projection. They usually come from CBO out of Washington, which is non-political or non-partisan, that the taxes will go up a total of about $400 billion. As you can see, those stats that I gave you, even if it goes up $400 billion, it still won't cover the deficit. So just keep that in mind. All right? All right. So the sunsetting, what it'll do is basically it'll bring back the old marginal rates. So you can see these are the current rates right here. That's what we're under right now. Now these are the marginal rates. It doesn't have the income levels, but you can see the top individual marginal rate right now is 37%. Okay? Under the old law, it's about 40%. So there was a decrease there. Every tax bracket marginal rate will go up except for the lowest and the next highest one. That'll stay at the same rate. It's what it's at. Marginal rates, what those mean is that part of your taxable income will be taxed at these marginal rates, and then the other part of your income will be taxed at a lower marginal rate. So it's like a blended of what's taking place. So I don't want to get into all the weeds in regard to it, but you need to be aware that tax rates will go up. That's why they'll be taking in another $400 billion if it sunsets. Okay, this is a big change that took place in regard to standard deduction. I've had a lot of clients in our firm, they no longer itemize their deductions because the standard deduction has become quite large. It was increased significantly. So just to refresh your memory, standard deduction used to be a lot lower than it is now, and there used to be a deduction for personal exemptions. So they took that out. The trade-off was they raised the standard deduction a significant amount. Okay? Another thing that you keep in mind, and I'm sure you've heard on the TV shows about the SALT deduction. Okay? And that has to do with the state taxes. If you don't live in New Mexico, I've got some dear friends that live in other parts of the country. And just give you perspective, property taxes in New Jersey. Okay? You'll be floored on this one. But my friend, I was talking to him, that has a very nice property in New Jersey. He's been very successful. He's semi-retired. His annual property taxes on his property are over $30,000. Property taxes. Okay? A lot of states have California, New York, Illinois. I mean, those are significant property taxes. So what's this SALT deduction? It created a lot of screaming from these high taxed states. And if you thought about it, I had never even thought about this before. The low tax states, especially in regard to property taxes, those U.S. citizens, taxpayers, were actually subsidizing taxpayers in these other states because they were being allowed a huge deduction on property taxes, for example, of say $30,000. So they lowered their taxes, but that means the other taxpayers were picking up the load. So I don't know if I never had looked at it that way because I think we all get in our silos. But they put a cap on it, on all the state taxes. I had some complaints about it at first, but because of some of the other changes that took place that we'll talk about, people started to back off. They liked it that our fees were a little lower because we weren't doing any more itemized deductions, and it was standard deduction, so they got a little bit of savings from us. Our fees were no longer deductible because under the changes that took place with itemized deductions, they eliminated that. One of the big ones, and they eliminated investor advisor fees. So Tom could relate to that. Those were no longer deductible as an itemized deduction. So anyway, they made quite a bit of changes. But the SALT deduction is a big issue. And if it sunsets, it'll go back to the old rules. which means that that $30,000 of property taxes in New Jersey will be deductible again, okay? So just keep that in mind. These changes, when it raised the standard deduction and less itemized, it was a little bit of a wash on the effect that it had on the tax revenues. I mean, that's what happens in Washington, is that every time you see these things being proposed, they have people behind the scenes, and all the elected officials want to know is, how much is the tax revenue going to go up or down? So how much money do we have to spend? That's what happens. Yeah. Yep, unfortunately. Okay, so if the SALT cap expires, it restores to the full level of deductibility under the old tax law. So there's some planning opportunities. I used to, with our higher income clients, we would usually meet the later part of the year when we were able to deduct the full amount of state taxes, property taxes, whatever, so they could prepay. Well, once the SALT cap was put in place, it didn't do any good to try to get together and prepay those items because it didn't do anything. So that strategy of doing planning related to that issue will come back if this thing sunsets. So just keep that in mind. The other one that's a big issue, and really I think it's being now taken advantage of in New Mexico. I had a hard time convincing some clients to do it, but New Mexico here, was it 2 years ago? The legislature made a change to allow entity level taxation, okay? And so it has to do with pass-throughs. So if you have a sub-S corporation, so if you're an S-corp or if you're an LLC, partnership type thing, you can make an election to have the entity pay the tax. And there's a computation that goes into effect. So what happens is that deduction flows through to the shareholder or partner. So they get to claim that as like a withholding on their personal return. I had some pushback in regard to it. They said, well, Brett, you know, we've never done this before. Yeah, I know. But we've tried to take advantage of it. What it really has to do with is because of the limitations on the SALT deduction, this became a lot more popular. Because if a client is paying a bunch of income taxes to the state, and you got the 10,000 cap on the SALT deduction, that basically means you're not going to have any benefit for it. So what a lot of the states have done is they've implemented that pass-through entity tax. In New Mexico refers to it as an entity level tax. And I'm doing it almost on everybody now. I had to do a little education with clients in regard to it, but it's something that, so when you're filing that business return, you have them pay that. And that got the attention of clients when they said, well, we've never had to pay a state tax before when we filed this partnership or S-corp. So I had to explain to them what was really going on there. And I find it to be a beneficial thing. And so we've really tried to take advantage of it, of trying to help clients to really be able to have that business pay it, deduct the state tax, and then let it flow through to the shareholder or partner on their K-1, and they're able to claim that as a credit on their return. All right, mortgage interest. If there's any questions, or if you don't understand some of my jargon or whatever, you know, just jump in and ask me. Sometimes CPAs have a tendency of talking our language. I run into it too. With my brother-in-law is a pulmonologist, and my wife is a retired nurse. So I have the same issue when they start talking about medical issues. So I've been dealing with a lung problem, and so I have to have them put that in simple English so that I can understand how good a shape I'm in or not in good shape. So anyway, on mortgage interest deduction, if it goes back to the old rules, if you remember correctly, under the act that's now there, they made some real changes on home equity loans, okay? So under the act that we're under now, it eliminated home equity interest unless it was used for specific purposes. I mean, I'm sure you've run into scenarios. I mean, I had clients that used to get home equity loans so they could buy a new motorhome, a new boat, you know, so they get a new toy. Well, under this act, those days are gone, unless it sunsets. And if it sunsets, it'll go back to the old rules. They also made some changes on deductibility of mortgage interest on your home. Now, most people don't fall into this category, but basically it went from $1 million to $750,000 of debt that you could basically deduct interest on. So what'll happen is, if it goes back to the old rules, it'll basically go back to the $1 million. And then it'll go back in regard to home equity loans under the old rules. So just keep that in mind. So if it sunsets, it'll go back to the old rules. You have to learn what happens. I have a tendency with clients, I'm sure you run into this too, you can't remember a lot of things of what happened 3 years ago, much less 5 years ago or whatever. So you have to sort of relearn what could potentially change. Charitable contribution deduction. Under the current Tax Act, what they did do, if you itemize, is, and they have a small deduction for donations, but this is really if you're itemizing deductions with significant donations, they raised the threshold or the cap of how much you could deduct. And basically they've raised it so that it's now 60% of adjusted gross income, which is that's your income before you get to taxable income. And they raised it from 50% cap to a 60% cap. So there's something on the books right now where it's in the tax code where if you want to, people that have required minimum distributions from a retirement account, where you can make an election if you want to do donations out of the retirement account, and it goes directly from your retirement account to the charitable organizations, you can make this election. And basically when you do that, you're not able to deduct it on your return, but it counts towards your minimum distribution. Okay? It's a really good tool. And I've probably got about a dozen clients that have taken advantage of this. And so what you're doing is, so let's say your minimum distribution needs to be $30,000. Okay? So let's say you want to do, instead you want to give $30,000 to large charities of your choice. That's right. Well, that would be well received. And appreciated. So when you do that, if you take advantage of, it has to work a certain way of being able to do it. But if you do, you can basically count that towards your distribution for the year. You don't have to pay tax on it, but you also don't get the deduction. So it's an offset. So you don't have to pay tax on it because it goes from your retirement account, which is sheltered. You don't have to pay tax on it till the money comes out. So it's not coming out, so it's being a direct transfer to these charities. It's a powerful tool, and if you have significant donations that you're making and you're getting a minimum distribution out of a retirement account, I would highly recommend to you that you take advantage of that.
They raised the amount from 100,000 last year to 105 this year.
Okay, it's good to know. Thank you. Right. Yes.
On the mortgage interest, real quick, what if you're an LLC? If the LLC owns the real estate, and the LLC deduct the mortgage interest?
If it owns, yes. If it owns, you're saying the LLC owns that real estate? Yes. Yeah.
In your example a second ago, I imagine the same thing will apply for a donor advised fund, right? So whether it's stock, retirement, et cetera.
Yes, absolutely.
I don't know, do you know the change, maybe it's on another slide, that's coming if that sunset happens or donor advised?
I don't think, I'm glad you asked that. I'm pretty sure that the sunsetting will not take that away. That's in a sort of a...
Gain stock, right? You can move to a donor advised fund and create
Yes.
that.
It's a great tool, and I've had trouble getting more people on board in regard to it. So.
Let me ask if I understand the question from the gentleman down there. Was that regarding the required minimum distribution to a donor advised fund? Or just general contribution?
Yes, I have a financial advisor I work with back east. I'm originally from the East Coast, and so what we set up years ago was donor advised fund for charitable contributions, right? So any stock gains, capital gains, what they have suggested is if I've got a lot of capital gains and want to move monies to the donor advised, that's completely all tax deductible at that time. The money stays in a donor advised fund. It's an investment based component, so any gains on those monies in the donor advised funds are also taxed, or there's no tax when they go to the charitable contribution. The only requirement is it has to go to charitable, a 501c, or charitable. You can't use it for any of the funds.
One thing I'd like you to check on that, because there could be an exception on those funds.
A change to that.
I didn't look it up, and I don't want to.
Yeah.
I just want to say I think you need to check that out. If it's under one of those funds, it's possible that this tool that I've thrown out might not be available. I'm not saying it's not, but I definitely want to check that out.
I believe it's not, because we just went through that, and there's a pretty tight rule. And I'm almost certain it has to be operating.
You may be right.
Check it out.
Yeah, you may be right. So that's why I wanted to put that on the table. It's possible that will not qualify. So, thank you for both of you on that feedback. Okay, so what'll happen if it sunsets? It'll go back to the old rule. So there'll be the 50% limitation on the AGI. Again, these are things I have to try to explain sometimes to clients when they say, Brett, you've made an error. I gave a lot more on donations. Well, it's being driven by your AGI, your adjusted gross income.
But you carry it forward.
You can carry it forward if you're not able to use it. That's correct. Yeah, thank you. Okay. All right. Under the old rule, there was a phase out on itemized deductions related to a threshold that was calculated based on your adjusted gross income. And so what happened is they basically, prior to the Tax Act, taxpayers could basically go through this calculation and determine if there was any kind of an effect on your itemized deductions. Like on miscellaneous itemized deductions, they would be limited sometimes because of these things. So again, this was taken away under the present Tax Act. If it sunsets, it'll go back to the old rule. And that's what it talks about down here. So it'll be 3% on that AGI number. But again, that's the old rule, okay? This one here, I love this deduction. And I think this is one of the fairest things they did in the present Tax Act. In my industry, we refer to it as the QBID deduction. And I think this is one of the fairest things that they did with this Tax Act that really helped small businesses, because the stuff that Linda put together, 80% of family-owned businesses operate as a pass-through, either as an S-corp or as an LLC partnership. And I find this one to be extremely fair, because what happens under the old tax code, before the current Tax Act, under the old rules, is that you get a K-1 of $50,000 of income. So you're going to pay tax on that. Okay, federal level, state, depending on whether you make that election of doing the entity level tax or not. But let's just focus on federal. So that $50,000 flows into your personal return. So it makes your AGI go up by $50,000. Okay, so it's going to put you in a higher marginal rate, even though that income may or may not have been distributed to you. See, keep in mind, on a pass-through entity, you may be getting distributions out of there. If it's an LLC, it's basically a draw distribution. If it's an S-corp, you're getting S distributions. There's no deduction for those. What you're doing is you're getting an advance on profits. Because I know I have to really preach to clients that when they get these distributions from these pass-through entities, they need to set aside I try to get a conservative amount of about 35% for them to set it aside. Because if they don't do it, guess what? They get hit with a big tax bill at the end of the year. And they go, well, I don't have that money. Well, that's not my fault. You use the money on something else when you were going to have to pay tax on it. But this, on the qualified business income deduction, what it does is it lowers the effective marginal rate. So by getting that 20% deduction, there's a calculation. Thank goodness I have software that does this. But basically what it does is it reduces the marginal rate So let's say the highest rate currently is 37%. It lowers it to 30%, 29.6. I find this to be extremely fair because what it's doing, that the pass-through owner is not being punished by throwing them into a higher marginal rate. I love this deduction, and it's made a difference in my own business. My business is an S corp, and I've noticed it on my own tax bill, where this has really helped lower my marginal rate, and I've got a lot of clients that this has really benefited, and so this is something that's in the current Tax Act that will go away, and this is a big one on the sunsetting. And what I'm worried about is with the politics that this could be an easy grab for Congress to get more tax revenue. By letting this sunset, this provision, that means it's going to go back to the old rules, and so all of a sudden, the owners of those pass-through entities, they're going to have an increase in their tax bill. So I really like this deduction, and it's something that I hope they do keep of going forward and not allow this provision to sunset.
Brett,
Yes.
is that, I don't know, this slide somehow confused me, that for that 20% deduction, is it literally that you don't have to pay tax on 20%? Or is it just that
It reduces your income.
so it does actually reduce your income?
Yeah.
It's not just your rate?
Yeah,
that's
it's on page 2 of the 1040.
Okay.
That's where it flows through.
That's what I thought.
So what it does is it basically just reduces, so you got the adjusted gross income, okay, then you have standard deduction. Well, you have this too. There's a separate line for the QBID that's on there. And after the calculation, there's a schedule that's in the return. It reduces the amount, so yeah, it reduces your tax bill.
Okay.
It comes off of the
It's
income.
not just the rate, it's the actual
Yes,
income.
yes.
So Brett, in your example, the 50,000, it's 10,000 deduction of that.
Yeah, there's some massaging that goes on in regard to it with some limitations. So I just don't want to say, yeah, it's that simple. It's not. But the theory is yes. So, and
This rate, it only lowers the rate if you happen to be
it's what it's
close to
doing.
the rate and that
Yeah,
$50,000
that's correct.
actually went to another.
Yeah, what it's doing is if you're in the top bracket with that deduction, it should throw you into about 30% marginal rate.
Depending on I mean, if you're making $500 a year, it's not going to matter.
That's correct.
Okay.
That is correct. And Linda gathered this through her research. Maybe it was in the stuff from CLA, but I was astounded. I had not seen that stat of 80% of family businesses are a pass-through. And I guess that does make sense if you think about it. How many family businesses are going to be a C Corp? A C Corp is, they pay tax at the corporate level at 21%. It's very rare. I've only got, I think I have 2 C Corp clients. And I've tried to get them to convert to an S Corp. I think it'd benefit them, but change is very hard for this particular client. So no, they wanted to leave it. They because one of the major benefits on a C Corp is employee benefits for shareholders. Because you can't deduct employee benefits if you're a 2% or greater shareholder in an S Corp, those are not deductible. But if you're a C Corp, it's a different rule. And so if you have a C Corp client with lots of employee benefits, a lot of times they want to stay as a C Corp. This is a big one in regard to the death tax, okay? It's very rare at this point in regard to estates under the old rule, okay, before the Tax Act was implemented. So basically the lifetime exclusion prior to this act was $5.5 million per individual, okay? That would not be, that amount of the estate was exempt from the death tax. And there's gift tax rules that come into play too, but I'm going to focus really more on the death tax. So it was increased significant amount to $11.42 million per individual. So you've got to have a very, very large estate to basically have to deal with the death tax, okay? So we do not have any clients that are married filing a joint return that have a net worth really, I think we might have one that it might come into play, but most businesses in New Mexico, you know, most of those estates are not going to be above that threshold. So that means what's happened under the current tax act is that most small businesses are off the table in regard to the death tax. Okay? But if it sunsets, it goes back to the old rule. Now it will be indexed for inflation. So it's estimated that it'll take it to 6.4 million per individual. Okay? But that's a big change. That's $5 million per individual that it could go down. So as a strategy, again, you want to pay attention to what's going on with the politics and the election. Is that you may want to be very aggressive on gifting and take advantage of these larger estate exemptions to family members. Because I think it's going to be very hard for you to be able to see an estate exclusion above 11 million apiece for quite some time. Of course, the way inflation's going, maybe that's not going to be that big a deal for some people. But I would highly recommend to you, again, keep an eye on what happens in the politics and Congress. You might want to take advantage and be very aggressive on giving gifts.
Yeah, Brett, if I can tag on this.
Sure.
The Supreme Court just came down with a ruling in the last few weeks. For the attorneys in the room, it's Connolly v. United States, where prior to this, if you had business-owned life insurance for the purpose of a buy-sell, if someone died, it would not be added to your estate. That has now changed. So
I missed that.
that's brand new, like in the last few weeks. So and that's why I'm bringing it up, because if you have
So now it will be included.
it can't be. That's one way it absolutely can't be interpreted.
It's a big issue.
Yeah. Yeah. So that wouldn't be the same for like cross purchase, but if it's redemption or entity owned, that's something that you want to review.
I'm glad you brought that up. That's huge. Yeah, because I've got clients that use that as part of their strategy of dealing with certain things. I'm glad. Thank you.
Yeah.
Now, one thing and Linda got this from her research, and I don't know how to comment on this, because it's this last sentence here. It's yet to be seen how a sunset will impact those who have given away more than the 5.49 million lifetime exclusion. What it's really referring to, if it goes back to the old rule, and you've taken advantage of that 11 million per person, how could you be punished if it sunsets? I don't understand that one. So obviously it hasn't been addressed, but that's a big issue. Personally, this is just my opinion. I don't see how they could go back and attack if you're doing these significant gifts under the present tax code, and then they allow it to sunset and go back to the old rules. I don't know how they could come in there and attack that.
Don't underestimate the government.
I mean, that's beyond unfair. Okay? So just be aware, that's something you'd want to discuss with a tax attorney, I would think, or your professional team. But anyway, I just wanted to point that out, because I think people should take advantage of the exemption that's on the books currently. Now, that's some big decisions of, do you want to give up control in your family business? Yes, ma'am. Oh, okay. So anyway, this is a big, big, big issue. And so I want you to be aware of it, think about it, and get with your advisors. So anything I bring up today, we've already talked about it. Make sure you talk to your CPA, your financial advisors, your tax attorney, your attorney. You need to talk to them. And you got to take the steps to be very proactive in doing that. Okay, I don't think these are real significant, but these are some items that will not sunset. So even though if the Tax Act sunsets on December 31st of 25, these will stay on the books. So the big one here, there's not a lot of R&D expense that takes place in New Mexico, but there can be. But really, and then the interest expense limitation, rarely have I had this come into play with a client, but it can. That's not changing. That's All of that's is going to stay on the books. And then this one here is a big one, the bonus depreciation. It's where you get to basically get accelerated depreciation on fixed assets that you bought. And the bonus system works. You've got to claim it unless you elect out of it. So if you don't elect out of it, bonus is mandatory. Well, what's happening is under a separate provision, it's being phased out between now and 2027. That has not changed. And as you can see here, there may be some congressional action to deal with that, but this does not change if the act does sunset. So I just want to point that out. Okay? All right. I'm the stand-in presenter, and Linda put it together. She got her materials pretty much from the Family Business magazine and from CLA. And I want to thank CLA. I don't think Barbara's here, so I want to make sure I recognize her firm.
Correct.
Yes?
Can you speak real quick to the new law that just went into effect in January, the Corporate Transparency Act and
Oh, the CTA?
CTA? And does that affect, I guess the bigger question is, does that affect 501c3s or nonprofits, 501c7? Are they required to file the appropriate information?
I don't think so because they don't have a beneficiary interest. There's no owner. If there was an owner, it would. Correct me if I'm wrong. If there's anybody in here that has been dealing with the CTA, I've sort of backed off. First off, we don't prepare any of them. I didn't want the liability. So what we did is, in fact, I thought I provided it to the Parker Center.
Some people are familiar with that.
Oh, the Corporate Transparency Act? Okay, I'm sorry. It went into effect this year, January 1st of this year. And so if you have a business entity that already exists, and then if it's a newer entity, you had to file this, I think yeah. If you started at January 1st, you had a deadline of, was it April, March or April? You had 90 days to get this done. If you're an entity that was in existence prior to January 1, you have until December 31st of this year to get this done. When we were going over our engagement letters with our clients this year, we did a separate one in regard to the Corporate Transparency Act. It's a big issue. We weren't going to do any of them. We were basically referring every client to their attorney. I'm not sure the attorney appreciates that, but we were not going to do it. We view it as a legal issue. And so the thing you need to be aware of, and there's a couple of things going on right now. There's court action that's taking place. But the reason why it's got to have your attention, and this should be more on the radar, the Treasury Department, they just want to get more information. They're just, Big Brother they want more from you. And what I'm worried about on this thing is it goes through a division of the Treasury, FinCEN, okay? What it's related to, the theory behind it is they're worried about money laundering activity, okay? And so if you're a beneficiary interest in one of these entities, S Corp, LLC, partnership, okay? You have a responsibility to do this filing. And like I said, and the penalties are severe. I couldn't believe, talk about overkill. The penalties, I can't remember what the dollar amounts are.
$500 per day up to $10,000.
Plus jail time.
Yeah.
You can be sent to jail as a felony. I couldn't believe it when I saw that provision. So I've got to do it for my company. I haven't done it yet. The reason why I haven't done it yet, there was a court case, in federal court in Alabama, and the judge, what do they call it? Stay? Is that what they call it?
Just in that state, though.
Oh, I thought it affected the entire country.
I believe it's just that state.
Is it just?
Yeah, because they wouldn't have jurisdiction.
So it's just in the state of Alabama? I thought it affected the entire country. But you're the attorney, I'm not the attorney.
I did not read the case.
Well, and it wasn't,
But that is, I read like a blurb.
and I guess didn't the judge say that the Treasury doesn't have any kind of constitutional grounds? I mean, correct me, counselor, I don't,
They made a constitutional,
yeah.
that it was unconstitutional.
So anyway, yes ma'am.
Other states sue and use that.
They use that case. Okay, that makes sense. Yeah, and that makes sense for doing it. I'm worried about it from a hacking standpoint. You're just getting more information to the federal government. Well, what if the federal government through FinCEN, what if it gets hacked? That means you got more information out there. And there's a process you can go through. I'm gonna have to figure this out for my company, but you can go and register through FinCEN, and you can get your own unique number identification, and you can use that to access it, and that gives you a little bit more protection. But if you haven't dealt with it, I would suggest that you get with your attorney and your CPA, but every CPA I've talked to, they don't want to deal with it. They don't want any kind of liability exposure for that, so they're telling the clients to go see their attorney. But my own attorney contacted me about it, so I was a little nervous when my attorney was contacting me in regard to the CTA. So,
Can you say, spell out the FinCEN, F-I-N?
what is, it's an acronym.
FINCEN.
Financial,
It's FINCEN.
Okay.
yeah, sorry. I just always refer to it as FinCEN.
Is there a threshold on that as to small companies versus?
No, in
That
that,
was 5 million. I said under 5 million.
you know what, you're right, I stand corrected. I'm sorry,
Under 5 million.
because I've been referring this to the attorneys, I haven't been really staying on top of it.
Over 5 million is exempt, under 5 million is.
That's right, under 5 million, under 5 million, you have to do it. If it's over 5 million, you're exempt. Thank you for pointing that out.
Is that,
So if you're a big outfit, you're exempt.
is that assets or anything?
I think it's gross revenue. I think it's gross revenue.
Is it a one-time filing?
Yes, it's a one-time filing.